now we turn to Asia and my favorite topic of China. And before we get into China, which again, what we're going to talk about relates to China in its own way, but Japan's defense spending continues to go higher. And remember back during Abe, there was an adjustment in 2013 about how they define self-defense. Now, for those that don't remember, back in 1945, we had deemed that Japan was not allowed to have a standing army. Instead, it was going to be something that was going to be supported by the U.S., which is why we have so much capacity in the region. But since then, we've tried to reduce some of our spending, and we've opened up the opportunity and actually welcomed the additional money being spent by Japan as things continue to ratchet up in terms of where China is and where Japan sits in terms of their relationship, how things now. Just going throughout history, China and Japan have never really liked each other, and that was a lot of atrocities from both sides. Obviously, most recently in World War II, there's a lot of pent up anger that has not gone away, and it's not going to abate anytime soon. As Xi calls they're going to atone for the century of humiliation. So again, these are some big components, but Japan is not sitting idle. They've entered into mutual defense treaties, and they continue to strengthen their ability to not only defend, but also go a bit more on the offensive in some of these regions. And it's important because when you look at Taiwan, so one of the things that I will vehemently defend in terms of my stance on this, the U.S., Taiwan is a red line. We will not let Taiwan go to China. End, stop, period. That is my belief. That I will defend that. I think that makes sense on a strategic level, on how we view the importance of democracy and capitalism versus communism. And we're showing it with not only how we have troops on the ground, we've sold them pretty much our most advanced equipment available, and we're also increasing our trade. We are relying on Taiwan more and more and more as our relationship with China declines. And I think these are some economic charts, because I can go through the defense side, where we're deployed, but let's look at economics. Why would we do this economically? Well, if we lose Taiwan, that we lose a significant amount of the IP that we have stored there, the investments that we've made, and it's all on the tech side. And is the world getting more or less technologically sophisticated? Are we relying more or less on semiconductors and on storage, on computers, on supercomputers? Again, these are important things, and a large part of it is made, built, assembled, and tested, as well as invented in Taiwan. So when you look at the trade in general, since Trump Chinese tariffs began, our imports have exploded from Taiwan. Our import surge, what is it being driven by? Shocker, semiconductors, telecom equipment, computer accessories, computers. Again, all of the key things that we need for the 21st, 22nd, 23rd century is being created, built, and imported from Taiwan. So then when we take this a step further and look at Taiwan versus the rest of the world, the total trade with the U.S., just to put it into perspective, because you could say, oh, well, we're just importing more globally. Yeah, but we're importing exponentially more from Taiwan than the rest of the world, because this is where we have a significant amount of exposure. And the growing exports, categories of goods with greatest increase since 2017, U.S. exports to Taiwan. We have always shied away from how much we push into that country because we don't want to show preferential treatment. We've also held the two systems, one country mantra, politically speaking. And again, the narrative and why it's so important to look at political language. But this is just showing that we've now moved past this. We've increased exports of crude. We've increased exports of industrial machines, aka the machines with the ability to make the stuff that we import from them. Again, that's important for us. Semiconductors, cars, all of these things are so important because we're increasing our ties, not decreasing our ties. Now, if we were going to show some sort of, well, let them have it, we would not be so aggressively trying to support them and giving them more and more equipment that if it fell into the wrong hands would be a huge blow to our intelligence community, to our ability to protect and finance and create the capacity of the computers of the future, the military equipment of the future, everything. Again, all of these reasons why we will continue to see and defend something so strategically important. But when you look at where are things going to go on an economic level, on a globally speaking. So here's a look at the change in debt, largely as a result of pandemic support across Asia Pacific countries. So when we look at where that has gone, so fiscal support and debt buildup. So the change in government debt between 2021 and 2019, you can see India, Vietnam, Sri Lanka, China, Malaysia. Again, a lot of these ASEAN nations have seen a huge increase in that fiscal support, a huge change in debt, which is why we keep talking about that fiscal drag, that consolidation, which we talked about in segment 4, where we're going to get some of those pressure points, which is why we expect to see a much broader slowdown. Now, the Asian gold import demand has adjusted. So remember, and especially when you start hearing about what the U.S. is going to do against China, against Russia, turn off SWIFT. What happens to your currency? What happens to the ability to access dollars? Well, if you have physical gold, some of that gets alleviated, which is why it's interesting to see how gold imports continue to rise. Gold purchases continue to go up as the dollar has gotten stronger and they try to find ways to, again, solidify currencies. What are they doing? They're raising rates, they're buying dollars, they're buying gold, all in a way to try to slow down the speed of inflation and try to shore up their local currency. Now, when we turn to China, you can see that the PMI composite, the Caixin PMI composite came in at 51.2. Services slowed a bit versus estimates, which is, again, what we were talking about last month, where it was expected at 53, came in at 52.1, as we kept saying that the services side continued to get a bit worse. Now, the reserve requirement, so the RRR, we've been saying from the beginning we were going to get a cut. And people were saying, no, we're not. And I was like, well, there's a chance that maybe it's kicked into next year, but we got a 50 basis point cut. We will go through that in more detail. On the export side, exports were expected to be 15.8%, came in at 16.6. Imports were expected to be at 15.8%, came in at 26%. So again, leading indicator for another positive move on the export side. And as we've been talking about, they're trying everything they can to support exports because that's the only thing that has been growing in their economy, and they need that for some sort of GDP growth, which is why it's so important. Foreign reserves ticked above expectations. It was expected 3.2 trillion, came in at 3.22 trillion. So again, still a positive move, but they still need a lot of cash to shore up their system. So when we look at the Caixin market, China services PMI, here you can see again that slowdown. We expect it to continue to slow and move closer to about 50, just based on what we're seeing on the consumer side and some of those additional pressures. But with the RRR cut, with some of the new, kind of the shifting stances, you're starting to see credit impulses flatline and bounce up. And this is what we've been talking about. We've been saying that you are going to get it stabilized, and then it's going to go sideways. We don't think you're going to get a huge shift up because we're not seeing the demand really for debt, but you're just going to get a stabilizing momentum. And that's where it's not really going to start to turn back up. It's going to go sideways, and that's going to be supportive of keeping the manufacturing PMI fairly flat. And that's where it's going to waffle back and forth between growth and whatnot. But when you look at just what the PBOC is still trying to do, they're still trying to offset They're saying that the RRR cut is coming at a time that they're getting a fairly sizable reduction in or maturities of liquidity, and they're trying to backstop it by just replacement, where they're trying to manage that liquidity, still trying to pull some out of the system as they still sit in a grossly over-levered economy. So what does that mean? Where are we seeing the RRR cut? So China reserve requirement ratio, came from the big banks to 11.5%, small banks to 8.5%, rural banks to 5%. Again, we thought it was going to be on small and rural. Instead, it came across the board. Still a way to kind of relieve and put additional capacity in. The People's Bank of China announced yesterday that it will cut the RRR for major commercial banks, releasing about 1.2 trillion yuan, or 188.5 billion of liquidity into the interbank system to underpin economic growth. In the face of an economic slowdown, a rebound in infrastructure investment is expected as China will enhance its financial support of Asian economic, thanks to vaccine boosters and better administration of the vaccine. The COVID-19 situation in the country could ease. The financial and property sectors are undervalued, and that could lead to upward movement. The Shanghai Bourse's main stocks index tends to have a 7-year cycle. The next peak may come next year after the slump of June 2015. So those are some quotes. There are some things I agree with and disagree with. And one of the big ones is what the RRR is going to do. We've seen it not get to where it needs to go in terms of deployed to companies that are struggling, companies that need support. And that is, I think, a bigger problem as we go forward. And yes, some things are struggling, but the property sector isn't really undervalued. It's still grossly overvalued with a significant amount of slack of unfinished projects. And that's what keeps the property sector overvalued, because you still have so much inventory left in there that is going to be that huge overhang. Now, I do agree that infrastructure spending is going to increase. It's an easy way to try to prop things up, but we've seen significant failure in terms of LGFVs, or the local government financial vehicles, special purpose bonds. Many of those that were done for infrastructure investments since 2018 are fully underwater. And the PBOC, the CCP has cut taxes, VATs, given tariff forgiveness. So local governments are seeing their revenue fall further. So how are they going to come out and do these infrastructure investments that just don't hold water? They'll try, because they want to make things look better as we go into the Winter Olympics, now that the U.S. has officially boycotted it on a political level. Not on our athletes will still show up and represent the states. But again, this is something that I don't think it's going to have the effect people are hoping for and wishing for, just based on it's still not getting to the right place. And we're going to look at where some of the demand is. So according to the PBOC, the 50 basis points will release 1.2 trillion yuan effective December 15th, which is the due date for banks to submit required reserve, and when a 950 billion yuan of medium-term lending facility will mature. So think about that. This is what we keep talking about. So they're issuing 1.2 trillion in the RRR release, but 950 billion is maturing. So what is the net liquidity? Again, this is what we keep talking about. They're trying to manage maturities and trying to stabilize liquidity here. They're not trying to prop it up, but they're trying to keep it fairly stable. The PBOC stated that the release cash will offset the maturing MLF, medium-term lending, meaning the PBOC will not roll over that specific function. Even so, the RRR cut will release 250 billion yuan to banks, increasing the amount of funds available for credit extensions. But we're also coming into year end, which is when they add a bit extra liquidity to the system. Again, not a huge thing when you consider the underlying RRR cut. The cut is in response to the economic slowdown, as we continue to see some of these pressure points when you look at where they're getting a bit worse when you're thinking about some of the pressure points on the economy in general. The Monday's announcement also reinforces the view that policy will diverge next year between the Federal Reserve, where they'll start to get a little bit easier, but the Fed will start to tighten. Now, this is coming from the China's Beige Book when you look at borrowing for Chinese firms. So when you look at the data, so let's look at the data. So large companies, so credit data by firm size, they when you look at it overall, the cut for SMEs narrative, so SMEs borrowing in 3Q, when you look at where things are in general, the small, medium enterprises are going down. The micro enterprises are going down. The large is going up. This is why we thought that if there was a release, it would be at the smaller banks, because large banks, large firms are still able to find capital. It's the smaller guys that are not able to do it. And now that it's a broad cut, again, it's not going to have the same type of impact. Then when you look at the pent-up demand for credit in China, it's fairly flat. There's no one who's driving out to, or driven to try to get some of this capital. The opposite can be said about the property sector. But there's fairly flat amount of activity because they're already sitting on so much debt, they're not looking to add to it. And I think that's a bigger problem and conundrum when you start looking at some of these underlying fundamentals. Now, when you look at the language shift between July and December, and I think the important one is looking at property. So in July, it was housing is for living in, not speculating, stabilizing land prices, home prices and expectations, promote stable, healthy development. Now, how has this shifted? Support the commercial housing market to better meet buyers' reasonable housing needs, build more subsidized housing, facilitate healthy development of property industry. It's that much softer. You're seeing them shift a bit to say, essentially, they're going to be more supportive. We've already seen them allowed to come in and hit the markets, increase some of their debt holdings, restructure. Caixin is currently continuing in negotiations in terms of trying to meet with creditors. And because Caixin creditors have yet to receive payment on a $400 million bond that matured Tuesday, putting the company on the brink of becoming the second major Chinese developer to renege on debt obligations this week. So again, there's a lot of incentive to try to protect this because this is not something that goes away next year either. And we'll talk about bond maturities going forward. 3 days after Premier Li flagged a cut in the RRR, the PBOC duly followed through. The central bank quickly came out to say the RRR cut in July did little to arrest the growth slowdown. After all, the economy is faltering not because there's a lack of loan supply, but because the real estate deleveraging has dampened the demand for credit. And we continue to see that. This is not a liquidity issue. There isn't a huge demand for this product. So China's growth outlook relies on whether the housing market can stabilize and whether investments in other industries can pick up the slack. Short answer, no. Beijing also offered a glimpse of hope. The Politburo on Monday promised to provide more affordable housing next year. It indicated Beijing will take more of a supply approach by increasing land and housing supply in the private sector. It's worth pointing out the previous RRR cut in July hasn't lowered overall corporate borrowing costs, as China Bull research pointed out. In fact, the weighted average lending rate for corporates rose by 10 basis points to 5.3% in the third quarter. In other words, the RRR cut didn't fully pass through to the economy. Where did the money go? At least part of the liquidity has been channeled to the bond market as investors borrowed short-term funds in the interbank market to buy government paper. The daily overnight repo turnover reached 4.7 trillion yuan, 737 billion on Monday, a level last seen in the early stages of the pandemic. So again, you're not seeing the movements, and this is the underlying problem. And then you look at consumption. So in July, tap domestic market, build e-commerce and logistics systems in counties and villages. Consumption in December, push for continued recovery, expand domestic demand. It's not happening, and this is where we continue to see these problems. But now let's look at bond maturities. China Evergrande Group chairman was summoned by the Guangdong government after the troubled property developer said it plans to work with creditors on a restructuring plan for its offshore debt. Provincial authorities will send a working group to urge the company to manage risks, as well as strengthen internal controls and management and ensure normal operations. And this is just looking at where a lot of these issues rely. We don't really have much information on the December 6th. There's some conflicting information on what has been paid. But when you start looking at Evergrande, when you look at these bonds, they defaulted as of yesterday. But Evergrande again has another slug, and with the grace period ending in January, which is why we have more pressure to come next month and next year. And it's set to get worse as developers run out of cash. So yes, they've hit the market, they've come to market, but there's still a huge amount of capacity that's unfinished, a huge amount of pressure. Domestic loans are way down. Self-raised has increased. They've been incentivized to put up their own personal collateral to bring a lot of this money in. Domestic loans continue to drift lower. Pre-sales are down. Again, all of these things are just showing how the cash crunch isn't really improving. Caixin Group Holdings, Chinese developer Evergrande admitted it may formally default on $10 billion in property bonds maturing in January alone. Caixin Group Holdings had been halted. Bond prices got hit again, as it is unlikely to win bondholder approval to extend the maturity of a $400 million bond due next week. Caixin proposal to delay the maturity of the bond by 18 months comes against the backdrop of growing creditor concerns, again, making it more and more difficult. So now let's shift gears a bit. So we've talked about China, we've talked about their issues. Let's look at Korea. As we've been talking about, domestic demand is getting worse. This is not just a Vietnam thing, Chinese thing. This is Asia in general, and South Korea is no different. And this is happening as rates are going back up, as inflation continues to worsen in the region. And Vietnam set to regain export share. So now as you're starting to see some of this shift, Vietnam has seen their local demand get decimated, but they're seeing a bigger share of the export market, which is what we've been calling for from the beginning as we get this shift from China into ASEAN nations, driven by, more specifically, Vietnam. In the pandemic wave surges in Vietnam, things have gotten a bit worse. But again, you're not seeing the same type of reaction because we're not seeing the same type of pressure on the hospital system. And then when you start looking at India services PMI remained at 58.1, still starting to weaken as inflation gets worse, which is why we think India economic growth slows, not to a negative point, but again, comes under a bit more pressure. As Japan real wages remain at record lows, again, leading into more pressure on spending, more pressure on buying, which is what we continue to see throughout the Asian nations. So if you have any questions, you know where to find me. Hopefully this was helpful and we provided some additional color. You can always find me at MarkFNY or in the comments section. And again, thank you for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.